brokerage call of the day, and Harsh is standing by with that. This is something we do right before markets open, and Kalyan Jewellers is in focus with a target price, hold your breath, of 700 rupees by JM Financial. Why is that, Harsh?
Well, yes, it's a near 20% upside which JM Financial is building in. It's an initiating coverage report, and therefore good interest. In terms of the jewellery market itself, it's quite large is what JM is saying. It's worth around 6.5 lakh crore in the current market context, but the organized market is just a shade below 40% of that, and therefore the runway for growth is extremely large. They expect to witness higher growth of roughly 20% for the organized market from FY24 to FY28. That's largely going to be led by better quality, improved pricing, transparency and consolidation in the industry. All those three will play in favor of a Kalyan. Increased gold prices actually aided the unorganized market over the last 2 to 3 years. So now, with gold prices likely stabilizing as per JM, this should aid the organized market better than unorganized. In terms of moats, Kalyan has quite a few. They have trust, transparency as well as effective marketing. They also have a hyper-local approach in terms of the way they market their jewellery. In each geography is very different, and the type of jewellery that they sell is also different. So the product mix is evolving. Further, they are adding stores aggressively. Expectations from JM, revenue CAGR of 25% all the way through FY28, 23% EBITDA CAGR and a 31% PAT CAGR. Lower capex requirement in terms of adding stock count. There's a larger tailwind than a Tanishq has because Tanishq is more penetrated. So Kalyan has that larger opportunity as well.
Okay, thank you for that, Harsh. Kalyan Jewellers there in focus. All right, Sandeep, let's come to your view on what you've seen with the tech pack and the IT pack so far. We've seen TCS numbers was a disappointment. We've seen HCL Tech numbers largely a disappointment. But do you think that there is a silver lining there where you see an improvement possibly in Q2?
Highly unlikely, Tamanna, because the macro factors don't seem to be improving at this stage. So my guess is that we will continue to see some stress going on. So these companies like the TCV order books, etc., have been okay for many of these companies. But the main issue is the project take-ups, executions, deferral of discretionary projects, etc. And there is a bigger risk, I would say, also standing in the mid-cap IT pack, because many investors seem to be sanguine about the prospects of mid-cap IT, where they say many investors are thinking that they will not be impacted, only the larger companies will be impacted. Historically, it's been seen that when discretionary spending gets deferred, the smaller companies also tend to be disproportionately affected. I think the mid-cap IT on a pure valuation basis right now carries more risk.